Hi, everyone. This is Jason Biark of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've listened to his interviews for years. He's been around the gold market for 17 years, and he's a fund manager at the Old Mutual Gold and Silver Fund. Ned Naylor-Leland, thank you for joining me.
Not at all. Thank you very much, Jason.
Now, Ned, I want to ask you about the gold rally that happened in 2017. It kind of had a stealth rally of around 13% in U.S. dollar terms. Has a weak U.S. dollar caused this gold rally?
Well, look, the first thing to say is not at all. It's like many narratives in financial markets, which is people sort of believe certain things, and they're often quite close to being true, but they're not correct. And the idea that the dollar and gold are inversely correlated, in other words, the dollar goes up, gold goes down, or the other way around, is just factually not accurate. And the reason why I say that with such certainty is because dollar gold is a foreign exchange cross rate. In other words, it's one number. So it's impossible for it to be, like that. Now, of course, when I say it's nearly true, what I mean is dollar gold and dollar real interest rates are absolutely perfectly inversely correlated. So, of course, what's really happened is over the period of that 12-month time frame, US dollar real interest rates, which is obviously the combination of inflation expectations and interest rate expectations, has dropped sufficiently to drive gold up in dollars. But obviously that leads into other points, which is, so in other currencies, the return profile was different last year. Sterling, it was weak last year because it had such a big rally the previous year. And it is fair to say that everybody needs to think about gold in their own currency rather than just in dollars.
Now, it seems to me that gold and silver have been really the only major asset class that has not participated in the everything bubble, as hedge fund managers have called it, the last couple years. Are you seeing the same thing?
Yeah, absolutely true. Yeah. Well, I'm not sure. I mean, there might be the odd other thing that we haven't sort of noticed, but pretty much the two things which by any sensible historic measure should be the first things to benefit look like being the last thing, but that also might be, where the huge opportunity lies, not just in the fact that there's a catch-up trade, but that, of course, it's kind of the nature of human beings and markets that would be the case. The final move will be into real money. When you have a monetary experiment gone wrong, and a lack of I'm not going to say knowledge, I think a lack of memory about where the monetary system came from, where it's likely to return to, what the true dynamics are in play, that until the price action is sufficiently exciting to drag everyone in, it won't happen. But once it does, I think it will be, as we say in England, a Katie bar the doors moment, because people will start to recognize what this means, and the narrative will roll like a snowball downhill. But that's true. I mean, there's been no participation at all since QE started for the monetary metals.
Yeah, the Dow has gone parabolic. It went from record time from 24,000 to 25,000, just went to 26,000. Seems like it was just at 25,000. And then we have European junk bonds, which have a lower yield, pricing in lower risk than U.S. Treasury on the yield, a lot of the yield curve there. And that's, I think, almost entirely because of central bank intervention, not just the Federal Reserve, but all the other major global central banks. The Swiss National Bank made $55 billion last year in trading profits out of money that they created out of thin air on a euro peg.
Sure. I mean, I think the part of the issue here, and I speak to lots of professional investors, is most people don't either care or really understand what money is. It doesn't come into their thinking. There are lots of things that do come into their thinking, but the nature of the monetary issue is not one of them. So, yeah, I mean, you look at I don't know exactly what the Dow's done since Trump came in, but it must be 40-something%, somewhere between, I think, 40 and 50% since he came in. So it's only just over a year. Now, that looks to me like, full Weimar trading behavior. It doesn't speak well to the underlying fundamental monetary problems. But of course, that's also what you're seeing with the explosion of Bitcoin and cryptocurrencies. That is also a function of the same thing, which is path of least resistance. I suppose looking for an exit from near cash instruments. At the margin, capital is fleeing those areas and seeking out real investments. Now, of course, I certainly think that the biggest and most important beneficiary in due course will be gold and silver, and particularly gold and silver mining stocks, which I think will become Their price action in a strongly rising gold and silver price environment will equate broadly to what you're seeing in the sort of the alternative cryptocurrency market at the moment. I think it will be quite similar to that. But for the time being, most of that marginal shift in assets away from cash and near cash and bonds is going into equities. It's quite interesting that it isn't really happening in property anymore. I'm not quite sure what the meaning of that is. But at the moment, it's not hitting gold or silver. But I think that's probably, if people are willing to think ahead a bit and allocate accordingly, allocate the correct quantum of their net worth or their portfolio. That's where the opportunity lies.
Yeah, contrarian indicator Paul Krugman, he predicted when Donald Trump won the U.S. presidential election that the stock market would crash. So naturally, with Paul Krugman, when he says something, it's going to be. I think he got the top award for Donald Trump's fake news awards yesterday.
Yes, I saw that. I have to say I was rather impressed by that, actually. It was a bit of a doffing of the cap to Trump. I don't know whether he came up with that himself, but that was a good choice. Not necessarily what one would have imagined he would have gone for, but hard to argue with.
Now, the gold chart, Ned, for the last year or so, it looks like it's been forming almost a perfect textbook bullish inverse head and shoulder chart pattern. Looked like gold was about to go to 1350 in US dollars, maybe even test 1400 in the near future. And as normal, with these things, it seems like the gold cartel comes in. Dave Kranzler, our mutual friend Dave Kranzler, put out an analysis on the commitment of traders. 100,000 new net short contracts on the commitment of traders came in to basically keep gold, I think, around 1329 right now as we're speaking today on Thursday. So how much longer do you think that this can happen? Can gold and silver miners, can they survive lower prices where maybe, this trades sideways for a little longer, the price goes lower?
So gold and silver miners are a lot more resilient than people realize. I'm not saying their price action works particularly well at times, but they're mining money. They rarely die. They have to be very, very, very badly managed to die, or very, very small and undercapitalized. They're a lot more resilient than people think. I mean, I think that when I think about the price now, there are two key observations. Look, I'm a great supporter of GATA and the work that they've done, and I think everything about the cartel and it really is true, supported by the evidence if one bothers to look at it. But I would also say that I think that the way it really works is through the function of the bond market rather than direct. So what I mean is that, because as I mentioned earlier, real interest rates, gold is just the inverse of real interest rate because it's always about flow of capital. Flow of the capital is far, far greater in cash and bonds than it is anywhere else. So I think that by managing real interest rates, the gold price is managed. And when I look at things like commitment to traders, I'm not so interested because I'm not a trader, I'm an investor. I want signals that are a bit slower than that. And the one that I look at, which makes me very confident looking forwards, is the 50-200 week moving average in gold and in silver. Now, that's a sensationally boring signal for anybody that trades, but it's a very interesting signal for people who invest because it's only, so if you look at a dollar gold chart going back, let's say, 30 years, the 50 and 200 week moving average only crossed 5 times in 30 years. That's very, very few data points considering the amount of time. And each time they've crossed, so whether it's a bull cross or a death cross, a golden cross or a death cross, each time it's happened, it's predicted at least 3.5 to 4 years of future direction. So each time there's been a golden cross, which has been 3 times, you've seen at least 3.5, 4 years of rising prices. And likewise with a death cross, now that means it has basically 100% predictive ability in terms of looking at momentum. And it did have a golden cross last year, as it did in silver. So that says to me that momentum direction is very much with us. Now, does that mean we can go down short term? Probably. Will we? I don't know. But in light of these longer term, more important grinding momentum indicators that are more meaningful for an investor like me rather than a trader, I'm quite comfortable with where we are. I don't know whether what I said makes sense to you, but I probably think about it in a slightly different way.
So you think then that the bottom, if it does go a little bit lower, that would just be the ultimate bottom then? Because when I look at the actual balance sheets of a lot of the gold and silver mining companies, they've written off, I think, over $85 billion in bad acquisitions since 2010, according to hedge fund manager John Paulson. That's a lot of waste. So they've had to do more with less. I believe there's not a lot of equity available for a lot of the different miners. The royalty and streaming companies are really coming in with this paper bear market since 2011, and they've been doing a lot of deals for cash flow because there's not as much equity available. So I think the miners have had to learn to be efficient, and I think that they can tread water, like you said, but I'm not sure if they can bring on any new supply in the near future without a much higher gold and silver price.
No, they can't bring on new supply. There's no evidence of that at all. But I think that the first thing I'd say is I'm not convinced by what Paulson says. I think that there's an element of sour grapes with him because his timing was so poor in coming into the space that some of the rocks that are thrown at the industry I think are unjustified. Some are justified. I think that the management generally are overpaid, but I think some of it's not fair. I mean, a lot of what happened is down to a perfect storm in terms of costs for the sector, which is, we had rising gold and silver prices for a few years, but costs were rising at an even faster rate than the underlying price of gold and silver was. And it's an important point to make. There have been efficiencies laid in. I think there's headroom here. I don't think that if there is a drop, it will be that big because, as I say, that particularly important and very slow-moving technical indicator, if one assumes it's going to work the way it has worked for 30 years, is telling you we're not going to crash here. There might be there could be a drop, but that suggests, unless it's going to be wrong for the first time, that we can have a huge momentum shift the other way, that we're well set, which means I think the stocks make a lot of sense now in the same way that they haven't before. Before, if you've got hugely rising costs, gold and silver go up, but these things don't make sense as investments because they can't deliver expanding margin. But if they can deliver expanding margin and gold and silver start to deliver good underlying price action, then the return profile of the stocks is very, very good. So I think you have to think about it slightly on a how is it now rather than on a backward-looking basis in terms of what the performance of the stocks was 5, 6, 10 years ago.
Yeah, that's fair. Unless the management team is still there, and they've made all these mistakes and they haven't been kicked out or the shareholders haven't dealt with them. So, but a lot of these companies, whether it's Barrick Gold or New Gold, have, when there was mistakes, a mine was overpaid for, a mine was not on time and on budget, like with New Gold and Rainy River, there was management team players that were basically kicked out.
Yeah, look, I'm not going to argue with specific examples. But it would be true of any industry. There are people who underperform, make bad acquisitions, don't do things well, and there are others that do. I could name you 5 or 6 stocks that have ridden through what we've seen with remarkable skill. So it depends on how you want to look at it. But one thing I will say, and this isn't a pitch in terms of what I do directly, but I don't think that investing in individual gold and silver mining equities is a sensible idea for anybody, including me or my analysts. The best way to invest in precious metals equities is through an index or through a fund, because they're incredibly technically complex businesses with a lot of moving parts and things that can go wrong. And I think the skew of owning one stock is a mistake. And I think you want to try and think about it in terms of, I want to capture 85% of all upside by owning at a minimum quite a few, and probably more likely an index or a fund. Because what you're doing then is you're mitigating the chance of a really big problem coming along and owning one of those ones that maybe you mentioned that have been, material underperformers for one reason or another.
Has U.S. retail investor demand for gold, silver, and mining stocks improved? Because it seems in 2017, especially when Trump won, that it basically collapsed. I could cite the statistics from the U.S. Mint. I've heard wholesalers and retailers, a lot of bullion dealers in the United States are not doing very well. Are things improving now?
Yeah, so I would say that it wasn't there either before it. So I think that the thing to realize is that, I'm going to sound like a broken record here, but gold, silver, and the mining equities all move on basis of real yield expectations in the bond market. And what happened with Trump was the first half of the year before he got in, and before it looked likely he was going to get in, we actually had a falling real interest rate environment. In other words, there were some macro problems in China. The market thought Hillary was going to win, and so everything headed towards your dollars are going to be costing you money sitting on deposit in real terms. And that drove a big rally in the sector, both directly because of massively depressed valuations, but also through rising spot prices. And then pretty much overnight there was a huge U-turn because the market suddenly, for whatever reason, perceived that Trump would be delivering a positive real interest rate environment. It was a bizarre thing to imagine, but that is what happened, and that drove a massive cool-off But I don't think there was retail interest really before or after. There hasn't been any retail interest for a long, long time in gold and silver. But of course, again, therein lies the opportunity. I mean, allocations are very, very low. When I speak to other broad-based generalist asset managers, they, except the ones that really think about macro and about monetary policy, no one's interested, no one wants to know. It's just not an asset class that anybody cares about. And the main reason why is because everything now is momentum-driven. People only want to own things that are already moving. They don't want to take a value. It's the same reason why value stocks don't perform. No one cares. No one wants to know about that. Of course, gold is a value proposition, isn't it? And it's not sexy. It's not interesting. No one wants to do that. Well, that's fine, and so be it. But that's where you need to think about it. That's the same reason why incredibly sensible deep value stocks have massively underperformed momentum ones for a very long time, because the whole investment universe has turned into that, which of course means that when the momentum is in gold and silver, in terms of price action, and basically we break above 1380 or 1400 or something and start to move higher, the momentum will tip straight in and everyone will pour in en masse all within 1 or 2 quarters. You'll see a huge move because hot money will chase it, in my opinion.
Yeah, I was going to mention that U.S. investors, particularly U.S. retail investors, they tend to not buy value. They tend to chase whatever's going up in momentum. So I actually know a good amount of people, and people who even listen to this podcast, that liquidated their physical gold, liquidated their physical silver, liquidated their mining shares, and started chasing cryptocurrencies the last year or so, trying to get rich quick. So, I try to warn them that, you have to find it, speculate on crypto or trade crypto, but you're not diversified then if you liquidate it out of your other investments and your other stocks, and you're trying to you own a couple cryptos and you're trying to get rich quick.
Oh, look, I think it's like anything, it's always about position sizing. Do you have your position sizing right? If you're 70% investing in crypto, you're probably making a big mistake.
You're a gambler, yeah. You're a gambler.
Well, and good luck to anybody who does anything. People do well, they don't. But position sizing is the thing you learn the longer you're involved in institutional markets. So for me, having a small position in Bitcoin in my fund, it's much easier for me to manage that investment correctly within my portfolio because its position in terms of size is correct. I find it relatively straightforward point spotting when it's over, really, really overbought, and therefore I'll sell, versus when it looks like everybody's squealing, and I'll tend to add it. And the reason why I'm finding it easy to do that is because it's small in my portfolio, i.e. the position size is right. Because once your position sizing starts to go wrong, your emotions come into it, and you need to consider position sizing as the other end of the stick to emotion. As soon as emotion comes in on any level, it means probably you need to look at your position sizing. Again, I don't know if that made sense what I said, but that's the way I see it.
I completely agree. So if your position sizing had a small percentage of your portfolio in crypto, and some of your crypto speculations or investments have gone up thousands of %, and now they're worth hundreds of thousands of dollars. And I have friends like this, and most of their net worth now is tied up in crypto, and they don't want to sell any. And I was telling them, well, you should think about rebalancing and putting the money into like cash flow rental properties, or maybe gold and silver miners, something more of value, rather than putting all your money in crypto. But I guess they either think crypto is going to go a lot higher, or they don't want to pay the tax. But it's a very dangerous game to have all of your net worth or most of your net worth in only one thing.
Well, it's true, but it's also true that there are a couple of other points here, which is that we're in a different moment in the cycle, aren't we? Where there's very little that does make sense. So it isn't quite as straightforward a conversation as it might be. And then there's also the secondary point, which you touched on there, which is about tax and the ecosystem of crypto itself, which has evolved, whereby a lot of the people who made the big returns, the early movers, they're just not interested in participating in pretty much anything else. As far as I've seen from the people I know, the one thing they do like is physical gold and silver. Fun enough, they seem to feel that and like that and understand that and realize that is complementary disintermediation of the financial system, in terms of the way they think. But there is also a philosophical side. It's true to say that a lot of people that are investing in crypto are not like that and are simply in it for a quick buck. But I'll tend to say weirdly that they're more likely to take their money and run. So look, it's a nuanced and complicated subject and a very interesting one. But at the core of all of it at all times must be this point about position sizing. Just try to be sensible. If you're getting emotional on either end of it, then you're probably you'll probably find your position sizing is not right. Because if your position sizing is right, you won't be emotional about it, and you'll be able to make more logical and probably more accurate decisions.
A lot of the people in the last year or so that have gotten into crypto because the prices were moving higher are not libertarian. They don't care about global central banks. They don't care about a decentralized, non-government controlled currency, and how governments steal our purchasing power. So they're just trying to get rich quick in a trending market, and some of them have even been buying a lot of their cryptocurrencies on credit cards, which is pretty darn scary. But do you think in 2018, Ned, that gold can outperform Bitcoin?
Well, I think it can. I mean, whether it will or not is a different point. I mean, I think that what I would say about that is whether it happens this year, I think there will be a moment where the whole narrative that exists currently in crypto will tip into precious metals, or monetary metals more specifically. So I think that there will be a year where that absolutely happen. It may seem improbable at this point, but I do think it will happen. And the reason really is because institutional money can't access crypto, even Bitcoin. I was just in the US meeting with lots of big banks, lots of big, portfolio managers, discretionary advisory, execution only, whatever. And even if their clients want to own gold, Bitcoin, they're not allowed to buy it. Now, of course, that's not true of gold and silver. So when the price action hit monetary metals and the momentum followed, then I think it's a sort of wave of institutional capital which is completely different to what you're seeing in the rather smaller arena we're discussing. So I think it can happen, and I think it will happen. And will it be this year? I don't know. But seeing as the other indicators suggest to me that gold and silver are pretty close to having quite a meaningful move, then it is certainly possible.
I started a little anecdotal Twitter poll yesterday. Maybe you could vote on this too. Only 18 votes so far asking the question if gold will outperform Bitcoin in 2018, and it's 2-1 saying no, that Bitcoin will outperform gold. So the majority of people still think it's tiny little sample size, but the people who voted, they still think Bitcoin will outperform gold.
Well, it is possible that they both go quite a bit higher, and if that happens, then the people voting may be right in percentage terms. If you said would it outperform the top performing gold and silver mining equity? Well, I would say probably not. So again, it depends on how you want to look at it, and there are lots of different ways.
Yeah, there's a lot of people who still won't go back into gold and silver mining stocks, and there was one mining stock called Leagold that Frank Giuster and others just listed. That stock went up 30-fold, while the gold price didn't do very much in the last 12 to 18 months. So if you know what you're doing in either you're subscribed to the right newsletter or you put money into a fund manager like yourself who can pick out winning stocks, a basket of these things, you can actually still make a lot of money during a bear market because there is opportunities in the bear market for the efficient company.
Well, look, it comes down to this. So if you're I mean, silver obviously is a more interesting version of gold, but if you're mining $100 of margin in a gold miner, that's your actual operating margin, and the gold price goes up $100, well, on the surface you should be making double your money if you're an equity investor. Now, of course, it doesn't work quite like that. In fact, it doesn't work anything like that. But it all comes down to costs. So if the costs were, let's say, flat, not falling, but flat rather than rising materially, and then you stick $300 on the gold price, which of course, let's be honest, at the moment is not really a big deal at all. I mean, it's sort of a third to half of the way back where we were 5 years ago. Then you're talking about making a really, potentially making a really large return as an equity investor, particularly as the price to net asset value multiples are very depressed, about half of where they are in a bull market, and even price to cash flow multiples are depressed. So there's lots of sort of room for them to really move. So I think the opportunity is very good, but I do think, like I said to you, that not buying individual, not name, and thinking about it in terms of an index or a fund does make more sense to most people because the technical knowledge you need to stock pick is very, very high.
Now, can primary gold and silver miners, can they cut any more costs at their mines, or do you think that they've already cut basically all the costs that they've cut, and they've cut those to the bone during the bear market?
No, I don't think there's any material costs that can be cut. I mean, ultimately, remember how capital intensive these businesses are. It's all about sustaining costs, about maintenance. It's not a cheap business. Now, could some corporate G&A be reduced? Sure, but in the grand scheme of life, it's not meaningful. It's not a really big input. So the answer really is no. I think that a lot of what could have been done has been done, and they're running pretty tight now, certainly compared to where we were 7-8 years ago.
I completely agree. Yeah, it's really tough with the maintenance capex, like you said. I was watching a presentation from Keith Neumeyer, First Majestic Silver, at the Denver Gold Forum in September, and this was before they just did the acquisition and bought Primero. But he was like, at their current mines, they don't have enough capital, enough free cash flow to reinvest to make the investments to continue to cut costs. So he was like, basically, they had 2 bad quarters in a row where their costs hadn't been continually moved downward, and their costs had actually increased a little bit. And I think that's a telling sign, because First Majestic Silver is normally known as one of the lowest cost silver producers in the industry, and they were struggling to cut costs.
Yeah, no, it's a structural problem, or rather, it's the right moment. Again, it depends on how you want to look at it.
What's your opinion then on the comments from the CEO of Randgold about gold miners need gold about $1,400 an ounce, or they're in trouble again and they won't be able to replace their reserves or increase supply?
Well, I don't think increasing supply is important would be the first thing I would say, because on a stocks to flow basis, supply really isn't what matters. But 1,400 as an industry on a forward-looking basis, it's not a bad number, but it's cherry picking. It doesn't really mean much. We certainly don't think about mining companies in a sort of pejorative generalist way like that. Every mining company has its own cost profile and its own opportunity set. So I don't know that it's an overly helpful point. I think that's probably more arm waving from Bristow than anything else. So I would tend to slightly move on from that one.
Yeah, I think his comments were more tied to like peak gold, how basically like it's a function of price, how without the gold price being substantially higher, the miners don't have enough free cash flow to invest into maybe exploration budgets or new acquisitions to increase supply.
That part is definitely true, which is that certainly the big guys have a reserve cliff that's right there. It's not even a long way away. But I mean, again, I tend to look at the optimistic part of that and say, well, put that into your investment thesis and own companies which are more likely to be lunch than the diner, and that gives you sort of unpriced, I suppose, merger and acquisition optionality in your portfolio. You can take that view into the way that you invest in the sector, and say, look, the companies that have got 2 to 3 mines in good jurisdictions with potential for expansion are interesting investment opportunities because they have additional optionality you're not paying for.
Couple more questions before I let you go. I want to ask you about our mutual friend Craig Hemke, ETF Metals report. He's been talking about this dollar-yen correlation affecting the gold price for a long time. Do you think that correlation still holds true, or has it been broken?
Look, I think it's definitely there. I mean, there's no doubt it's there. It's a bit of an elephant in the room. I think that the real interest rate point that I made earlier, which is basically a US dollar bond market function, and the dollar yen, they're all the same point. It's like a risk-free cash rate, whether it's through yen or through dollars, whether there's an actual coat hooking going on by the LBMA through the dollar yen function. In other words, they are somehow booking their structural short position in gold by, I suppose, if you want to say it, delta hedging through dollar yen. I don't know. I mean, it's a thesis I've had and discussed with him before. It might be the case, it might not. I think it's definitely notable, but it's all the same point, which is the market for now wants to think about gold as a opportunity cost decision versus a cash, whether it's a yen or a treasury position. Now, is that burning a hole in my pocket or isn't it, on a forward-looking basis? And it's quite clear that both yen and dollars are burning hole in everybody's pocket that owns them. However, the data and therefore the bond market are not admitting this. So you increasingly got a situation where this becomes more and more and more and more obvious that the data and the bond market are wrong, and that cash, whether it's dollars or yen, is hurting you. And then I think there's a moment where suddenly everyone just says, hold on, I can't do this anymore. I don't think we're quite there yet, but I think it's getting closer. So
do you think then that the bonds are, especially government bonds, are in a bear market now that the central banks are threatening to take away the liquidity punch bowl with the ECB, the Federal Reserve threatening to drastically reduce their bond buying programs and their liquidity programs?
No, I don't buy that at all. I think it's self-serving narrative. They have to say stuff like that. The market eats it up like a good puppy. But no, I mean, look at the trend in yields over 35, 40 years. It's always been the same, which is you reach the top of the channel and you start hearing about it's all over. I don't think it's all over at all until it's completely over. So no, I don't buy that particular narrative.
And the yield curve in the U.S. is flattening. Do you think it's going to end up going inverted in the near future?
Well, look, that, of course, is by inference. So this is, I suppose, an interesting point. The 5200-week moving average that I keep talking about is predicting higher gold price. Higher gold prices is predicting lower real interest rate. That is the opposite of what the bond market thinks. So to answer your question, I think it's a possibility, and I think that's what the gold price on a forward-looking basis is suggesting. So I think it's definitely in play, which is that everybody in the bond market is wrong. They're all expecting normalization, punch bowl removal, back to 4%, and gold, in its function as an inverse play on real interest rates, is telling you, no, you're all wrong on this. This particular moving average of gold is so predictive, and it's saying everybody's wrong. So I think it's something to keep an eye on.
That's very interesting. And so that would be then the financial repression that we've seen really since the 2008 financial crisis, where the central bankers have, drastically lowered the interest rates basically to zero. And then we've heard these Keynesian academics even talking about negative interest rates, which is ridiculous.
Well, I remember as soon as we started the most recent tightening cycle, I think we were one hike in, and I got a letter from my bank in the UK telling me that they had the right to charge me for deposits. So while what we're hearing is one thing, and what base rates was one thing, but the commercial banking sector seemed to be moving in the opposite direction and laying the ground for the other way. So who knows? Either way, I think that this monetary system is on borrowed time, and a fairly radical new monetary system is clearly pretty close to hand at this point.
Yeah, I think I completely agree. I'm surprised we haven't crashed already, but with all the money and credit that these global central banks have put in, they put in tens of trillions of dollars. So it's not surprising then that the asset prices would go up, while the real economy, in my opinion, is not doing as well as the asset price. There's larger and larger disparity between the asset prices going up and the real economy.
Yeah, absolutely. Absolutely true.
Question then about Brexit and an update on that. So I know Brexit has been slowed. Do you think Brexit basically has been cancelled at this point by politicians in the UK and the bureaucrats in Brussels?
I'm going to slightly fudge it. I mean, generally, I'll give you a pretty direct answer on most things. I'm pretty skeptical about all of these things, one way or the other. I don't pay a huge amount of attention. I tend to think that whatever they say is probably not true. So I think what you say may well be the case, that the whole thing is a sort of very tiresome charade. I'm not sure. I think that the two camps that existed as the vote came out are fairly entrenched in their view. I haven't seen much variation of people's views. There could be another vote. I'll be honest. This is not my subject. I tend to sort of sit back and observe. Maybe I should be a bit more active about it, but I find it all a bit silly.
Yeah, it seems the lawyers in power, the elites in London and the elites in Brussels, they're lawyers, and they've been delaying this thing as long as possible, and they're hoping to turn the tides with another vote. So, they've been intentionally legally dragging their feet on this, and so they can, run a campaign to turn the vote around.
Well, yeah, I mean, what comes to mind for me is that amusing cartoon one sees online a lot of the cow trying to choose an entrance to the slaughterhouse, left or right, or the illusion of choice, I think it says. Yeah.
So last question before I let you go. 2018, I think, is going to be a more volatile year, although there's been the central banks, especially the Federal Reserve, started this leverage short volatility trade, and other traders have piggybacked this thing. Do you think it's likely we're going to see in the next couple of years Dow 40,000, a stock market crash, or both in the next 5 years?
Gosh, I mean, it could, as you know. I mean, the reason why you asked me is it could be any of those. So I don't know. I mean, at the moment,
we could see both. I think we could maybe see both. The order of predicting which one happens first would be kind of tricky.
I think over the time frame you painted it, I would say both is more likely. But yeah, this can roll out anyway. But mill pond volatility and everything is marvelous, including like 6 to 8 rate hikes. I'm certainly short that thesis one way or the other. other.
Yeah, and I think gold has definitely bottomed. Maybe it has a little correction, and I think the dips are now being bought. I think the gold bull market restarted last year. Most people didn't even pay attention to it because of the stock market going up and President Trump and cryptocurrencies doing well. But I think gold has finally put in a bottom. Now we'll see how high it goes, but I've invested in companies that can make money. So I think that's the key is to, I think a lot of people, they see some of these ads on YouTube videos and they gamble on some of the really, really speculative junior miners that, might not even have a viable gold deposit, and they're hoping to get rich off of those. And, that stake that most people, when they invest, is they put way too much of their capital into.
Well, in that case, coming from somebody that manages a fund in the space, I would reiterate the point I made a few times, which is, so as a desk of people who have meetings all the time, are able to properly model these companies from the ground up, on every way, both financially and operationally. We don't buy individual mining stocks ourselves, so there's probably a message in there. Reduce your risk, retain most of the upside, own an index or a fund. Don't go piling into individual stocks.
And what do you think then about the GDX and the GDXJ, rebalancing? There's still issues with that, right? Even after the rebalancing, they're gonna, when gold and silver go on another run, the miners go up, they're gonna have to rebalance again. There's still problems with those ETFs.
Sure, absolutely. Look, it's not a clean way of gaining exposure, and I don't think either would outperform the equivalent actively managed product. In fact, they don't. But those things have very good liquidity, and they serve purpose for some people. Some people would rather not pay the fees and use those, and they have their merits too.
And when they rebalance, like some of those individual stocks in the ETFs, they dropped almost 20% in a single day because the ETF was the largest holder of the stock, and then they just indiscriminately dumped the shares, very quickly.
No, absolutely. I mean, when the rebalancing happened, we'd analysed what was going to take place. We worked out that we were going to be a net beneficiary overall of the whole reshaping, so we chose not to do anything about it, and it worked fine. But it's probably another reason not to own individual names, because stuff like that can happen and you can be on the wrong side of it. So it just sort of rather reinforces, the main point.
Very good. And is demand for physical gold in China and India still strong?
Well, I think it's always strong. A lot of that is a misplaced sort of emotion, because it doesn't make any difference to the price. Whether demand was weak or strong, it doesn't move the price. I mean, there are people who work for LBMA institutions who try and argue the toss on that, but it doesn't make any difference. It's a real interest rate play. Gold moves based on nuanced moves in the bond market and inflation, not on physical demand anywhere, whether it's China, India, US, Canada, UK, or anywhere else. It just doesn't, all I know is over 20 years, more and more people want to buy physical with more and more liquidity. That trend is very clear everywhere, but it does not affect the price until there's a run on obligations, which of course will happen at some point, but right now that's just not what moves the price.
Very good. And I want to thank you again for your time today, Ned. And if our listeners want to do more research about your gold fund, Old Mutual Gold and Silver Fund, how do they do so?
Well, I'm sure they can do that through our website or through their financial advisors. I mean, it's probably not available for onshore US investors, but there's stuff available on our website, and I'm out and about actively chatting about what we do.
Yeah, and you're on Twitter, so I'll put a link to your Twitter handle on there. You post some interesting things on there about the gold market. I want to thank you again for your time today, Ned, and I really enjoyed discussing about the gold market. I think it's a very interesting time for markets in general, with the cryptocurrency, pretty much the everything bubble. It's ridiculous kind of how everything buckle and silver has gone up, but I think, finally we're starting to see light at the end of the tunnel for this paper bear market. I think it's basically...
Well, here's hoping, and good to chat to you.